I think we've been telling our clients for some time that the growth and global growth is made up of two constituents, the USA and emerging markets. And I think that Jamie just continues to echo what's happening in the U.S. And I think this definitely takes off the fears that the rhetoric that everyone's talking about inversions, recessions, earnings recessions. And I think we're getting back to business of high-quality companies delivering high-quality earnings.
I'll tell you what, Josh, you know what they liked more than his comments? They liked the numbers. Stock's up 4.5%.
Net income up. Look, the consumer bank at J.P. Morgan saved the day. The good news is that's the biggest part of the bank, and that's where all the growth is. So trading wasn't great. M&A advice and investment banking is off to a slow start. No big deal. It's not catastrophic. In the meantime, consumer bank is on fire, and that's because consumer confidence is on fire, and because money is still cheap, and because now you've got better, more favorable rates for mortgages again. So the first-time home buyer came back. The refi came back. New mortgage applications. So if you have the biggest consumer bank in America, which I think J.P. Morgan does, or the second biggest, all good things. And I think when you think about J.P. Morgan, look, this is my final trade yesterday. I've been begging people to buy the stock at about $100 a share for a very long time. At a certain point, this thing will break out and not come back. So far, every one of these bank rallies has been a failed rally, and then this stock revisits $98, $100 a share. At a certain point, it just won't anymore. And I could see a scenario where this is a $125 stock into year end. You need a lot to go right, of course, but it's not expensive. It's a premium to most other big banks. But globally speaking, relative to all of the stocks in the market, it's still a bargain. So I'm staying long. I like it. I like the dividend. I like everything that Jamie had to say.
You know what's amazing, Stevens? We tend to see stocks, especially the mega caps in similar spaces, usually trade a little bit the same. Wow. Look at Wells Fargo, massive consumer bank. Wells Fargo stock is down right now 3.8%, a nearly 8-point swing between JPM and Wells Fargo today. Incredible.
It is incredible, and while they've beaten the top line, they've beaten the bottom line, you still don't know who the CEO is. It's still a punching bag for Congress. And it's still not particularly cheap, by the way. So would you rather...
Wells.
Right, Wells. So would you rather own that or a quality bank with good management, great management, or one of the others like B of A, which also has great management? But look, these at the end of the day still are going to be, for the intermediate term and the short term, proxies for the bond market. And without a steepening yield curve, they're not going to be growth stocks. They're not going to move up higher. So a lot does have to go right to get it there. But I'd like to go back to what you said. We can't ignore the fact we've had two S&P companies report. We got a long way to go. The facts are that there was a slowdown, and the facts are that analyst estimates came down dramatically since December 31st. So while there might not be an earnings recession, because you need 2 quarters to get to a recession, you have seen a decline. So we've reset the bar lower. So what the market trades on is expectations.